Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to this Peak Prosperity Podcast. I am your host, Chris Martenson. Last week saw oil close at a weekly low below the emergency, the world is falling apart lows of 2009 and back to levels not seen since 2004. Now, as you know, energy is the master resource, and so we have to wonder deeply about what this plunge in oil prices is really telling us. Now, separating the signal from the noise is essential, but never more so than when you're talking about the master resource. Oil is the master resource as far as I'm concerned economically. Now, does all of this oil price plunge mean that peak oil is wrong? Does it mean that oil companies have figured out how to produce oil profitably at 1/3 the oil price from a year ago? Does it mean that demand is falling off a cliff or that supplies are skyrocketing? To help us make sense of all of this, by far is my favorite oil analyst and energy specialist out there, Arthur Berman, who is a geological consultant with 37 years of experience in petroleum exploration and production, with 20 of those at Amoco, now part of BP. He's published more than 100 articles on geology, technology, and the petroleum industry during the past 5 years. Publication topics include petroleum exploration, oil and gas price trends and cycles, petroleum play evaluation, sequence stratigraphy, coastal subsidence, earthquakes, tsunamis, and petroleum geopolitics. He's published more than 20 articles and reports on shale plays, including the Barnett, Haynesville, Fayetteville, Marcellus, Bakken, Eagle Ford shales, all ones that we cover here at Peak Prosperity pretty routinely. Now, during the past 4 years, he's made more than 50 presentations to energy sector boards of directors and executive committees, financial analyst conferences, oil and gas association meetings, and engineering and geological society meetings. Listen, Art's been out there attempting to tell the tale that something needs to be examined a little more closely when it comes to oil, particularly shale oil. We're talking to a true oil expert in this subject. Welcome, Art. It's great to have you back.
Thanks, Chris. Thanks for having me back.
Well, let's start right at the top. The collapse in oil prices. What's driving that in your mind?
The same things that always drive prices. In the end, it's always about fundamentals. The markets are peculiar and they change every day. But the fundamentals of supply and demand, at some point, markets, come back to those and have to adjust accordingly. Not on a daily basis, maybe not even on a monthly basis, but eventually they get it right. So this oil price collapse is real straightforward as far as I can tell, and it has to do with cheap, stupid money because of artificially low interest rates that resulted in overinvestment in oil, as well as lots of other commodities that are not in my area of specialty, but that's what I see. And overinvestment led to overproduction, and eventually overproduction swamped the market with too much supply, and the price has to go down until we work our way through the excess supply. Now, the wrinkle in all of this is that because the supply excess or surplus was generated by debt and a lot of correlative instruments, the problem is that the companies and the countries that are doing all this overproduction need to keep generating cash flow so they can service the debt, which means they have to continue producing pretty much at the highest levels they possibly can, which doesn't really allow very much room for reducing the surplus. So that's piece number one. And then there's the demand side. So the thing that drove all of this overinvestment and overproduction were high prices. And after a while, people get tired of high prices, and we see a phenomenon called demand destruction. Or, as Jamie Galbraith calls it, the choke chain effect. Your dog runs out on a leash and eventually, it stops and he chokes. And And so we're dealing with that. People have changed their behavior because of high prices. And then we add to that the fact that people just change their behavior. I mean, young people aren't driving as much as they used to. They spend their time in a smartphone more than they do in a car. We've got climate change issues. There's considerable momentum toward cutting back on fossil fuels. Add it all together, demand is down, supply is up. It's a bad situation.
Now, this oversupply has been with us for a little while. It's help people understand this, because it's not a huge amount. I mean, the world does burn of total liquids, I'm rounding here, 90 million barrels a day. How much are we actually oversupplied on a daily basis right now?
Right. Well, okay. So there's a distinction that has to be made between oil and liquids.
Okay.
Okay. So when we're talking about the world, we're generally talking about liquids. That means crude oil plus a lot of other stuff, refined products, natural gas liquids, biofuels, you name it. Okay. So the number you cited, which is 94 million barrels a day. That's total liquids. Okay. That includes, gasoline and jet fuel and all that stuff. The crude oil piece of that is somewhat less. It's around 74 million barrels a day. So that's, that's the context. And so let's talk about liquids. And we're oversupplied in liquids by approximately 1.5 million barrels per day. Now, like you say, that doesn't seem like a lot or a huge amount as a percentage, and it's not. But in all commodity markets, certainly in the oil market, which is my expertise, it doesn't take a whole lot before it drives the price down. I mean, a glut or a shortage, can be a whole lot less than 1.5 million barrels a day. And in fact, 1.5 million barrels a day is pretty high by historical oversupply standards, and it's completely anomalous in terms of the length of time that it's lasted. I mean, we had oversupply spikes of a month or 2 or 3 months several times in the past decade or two, but they adjusted out pretty quickly. And that's because first they were related to some anomaly, either a supply interruption or, the end of a supply interruption. And they occurred during periods when there was more geopolitical risk in the world. In other words, there were civil wars going on in places like Libya or whatever that could quickly reduce the overall supply and therefore bring down the surplus. What's happened here in the last 3 or 4 years, certainly, is despite all of the turmoil in the world, I mean, the world hasn't gotten any safer, but for whatever reason, coincidence, we just haven't had any significant supply interruptions. And so there's no safety valve to absorb the excess production as there had been prior to really about the middle or beginning of 2014. That's when the oversupply really began to bloom.
And that's also when I think, OPEC decided, particularly Saudi Arabia decided this time around they weren't going to be that swing supply cutter. They weren't going to come out and absorb the 1.5 million overage by dialing back their production. So there's some geopolitics. There's obviously some maneuvering going on the part of Saudi Arabia here, which is a little different than the past. And I'm not saying Saudi Arabia should be the swing producer. Maybe the United States could dial its production back, or anybody else. But that's potentially a new behavior this time around too, isn't it?
Not really. Our memories are short, and if Daniel Yergin and enough pundits and journalists say that Saudi Arabia and OPEC are the swing producer and supposed to be the swing producer, then eventually people start believing that they are. But I mean, you can go on the EIA website and access a graph pretty quickly that has a very prominent data point, which is somewhere in the middle of 1986, and the caption says, OPEC abandons role as swing producer. Okay, so, I mean, that was, 30 years ago? Almost 30 years ago? And so the truth is, a swing producer, in my view, is kind of a dumb concept. The United States can't be a swing producer because no one can pick up the phone and say, okay, tomorrow we're dialing back production by 1 barrel or 1,000,000 barrels. Saudi Arabia can do that. Russia can, autocratic countries can do that. The U.S. can't do that. There's too many moving parts. There's, thousands of independent producers that are all pursuing their own internal objectives and strategies. So, but back to your point about Saudi Arabia, whether or not they were or should be the swing producer, and I'm not a great apologizer for Saudi Arabia, but in truth, what they've done here is just good business sense. They looked at the situation and they said, "Oh my God, there's all this new supply in the world, and we and OPEC we could cut 1.5 million barrels a day or 2 million barrels a day and bring the price up, to whatever level really that we might want on a short-term basis." But here's the problem: we bring the price up, and all the companies and countries that are trying to cut back their production will say, gee, thanks, guys, we'll just dial up production. And in almost no time, what happens is that the oversupply has now become even worse. And who suffered from it? Well, the people that cut production. And who benefited? All the cowboys that didn't cut production. So from a business standpoint, I think that OPEC is saying, well, that's a dumb thing to do. What we need to do is figure out a way to get those guys to cut back so that eventually price goes up, or we can decide to cut and artificially increase price, or just gain market share, or heck, just discover what the new order marginal barrel cost really is, because we don't know with all this tight oil and God knows what. So that's the way I read it. Maybe I'm being too generous or naive, but that's the way I see it. I don't see that cutting production would accomplish very much of anything except make the situation worse in the fairly near to medium term.
Well, I guess then, the way I look at what you just said is, if I'm OPEC, I'm looking across the near and the long term, and I'm noting a couple of important trends. And I've seen the rise of the shale oil, and that's sort of concerning on one level, but I think you put your finger on a different piece, which is that they have very little, OPEC has less control right now, and they won't have control. They won't have the ability to both cut back and see prices rise until they gain some of that control back. So I could see that as part of the strategy. Now let's here's another observation I've had is that, with this pretty much 2/3 price cut in oil from its recent highs, there was supposed to be this big uptick in demand. Are you seeing that? Is demand really responding to price for oil?
No, is the simple answer. And of course, it's always more complicated than that. And so, sure, I mean, there are bright areas. Consumption of gasoline in places like the U.S. and China, showed a fairly predictable increase with much cheaper oil and therefore gasoline prices. But unfortunately, or fortunately, the United States and China being the two biggest economies of the world, they're still not the whole world. And besides, these kinds of spurts don't last forever. So, it seems to me that whatever we saw, let's say, in the United States in terms of an increase in gasoline, and, let's face it, I mean, transportation is, a good 25% of total oil consumption. So it's hardly trivial. But, okay, so we did it and now it's over. We're not going to keep exponentially increasing our driving. We kind of did it. Summer driving season's over. So, now, maybe we've leveled off at a higher level, but it's not enough. Okay. The world the world 30 years ago, when we had our last big oil price collapse back in the 1980s and 1990s, petroleum consumption was limited then pretty much to the United States, North America, Western Europe, and now it's a different story. I mean, now we've got the whole world consuming a lot more oil than they did before. So everything is more complicated.
Okay, all right. Well, thanks for that. So the big picture obviously is supply and demand. That's a real price driver here. Now I want to turn our attention to a little bit closer to home. I just can't wait to talk to you about this, the shale plays, because I've been tracking them for a long time. I've been a fairly big proponent of David Hughes' work, which is out of Post Carbon, really talking about just the, it's fairly simple at one level. There's in any given shale play, there's only so many places you can drill. And then secondarily, there's sweeter spots and less sweet spots. And then thirdly, everything really depends on the ultimately recoverable amount of oil, the EUR that comes out of a given well. And I've been following some work over on Peak Oil Barrel, and particularly by this guy Eno Peters, who's just taking all of the well data in the Bakken and clearly showing vintage by year what each well has produced, each cluster of wells for that cohort. And you sort of draw those curves out by eye, and you see that there haven't been any massive improvements in well productivity over the past few years. And secondarily, that if you just by eye, you can sort of tell where they're all sort of running out, excuse me, at about maybe 350,000 barrels per well, somewhere in that zone, as for an ultimate recoverable amount. And still, Art, when I look at the operators in those plays, they're claiming that they're going to get twice that, sometimes even more than twice that out of each well. And so when I've calculated the economics in that play myself, I've got a little spreadsheet. I did my level best, and then I found that you had calculated what's going on in that play as well. So let's cut right to that. So in the Bakken, how many wells that get drilled out there right now would be economic at today's prices?
Almost none at today's prices. I mean, the latest from the North Dakota Department of Mineral Resources says that wellhead prices are in the 20s. So, I published a report not very long ago that said that 1% of the Bakken was breaking even at $30 oil prices. So, now we're below that, and I don't remember exactly what percentage of wells, but it was something like maybe 5 or 6%. But so right now, I mean, let's face it, Chris. I mean, let's just get it right out there in the open. Everybody's losing their ass at current oil prices. I don't care what they say. I mean, I'm in this business, okay? I mean, I just drilled 2 discoveries in the last month or two at the bottom of the cycle, and we can make a weak profit off of what we found. First of all, they're conventional reservoirs, so they didn't cost us $6 to $10 million to drill, and we don't have to drill them horizontally. We don't have to frack them, but and we got no overhead and we got no debt. So that puts us in kind of a really different situation from most public companies. So the truth is that everybody, the best positions in the best plays in the United States, the core of the core, if you will, nobody can break even at less than about $45 a barrel. I mean, that's just reality. And that's not sticking them with, their land costs that they sunk and wrote off long ago. That's just, basic operating expenses and severance taxes and stuff that, I publish in all of my reports, and nobody ever argues with me about that. They may disagree with a lot of my conclusions or et cetera, but they never say, oh no, your economic assumptions were way off base. No, they're not off base. So take that to the bank. And let's just, let's just get that whole silly conversation off the table. everybody's losing their ass at $20 or $30 oil. Everybody. And that includes Saudi Arabia and Kuwait and, everybody in the world is. But certainly U.S. producers, the very best of the best, they got to have 45 or 50. And that's a small subset of their wells in a play. And realistically, $60, 60, 65 is bare bones kind of for, the average well-positioned company, all of their better wells or, current wells in a play. That's just the way it works. And if you hear something else, ask a lot of questions like, tell me what costs you're excluding, because that's the only way to get there, just by excluding costs.
Well, I guess there's one other way. I'm actually looking at a Bloomberg article right here that the headline says that shale companies can make money with oil at 30. And so digging into the article a little bit, I think what they've done is they found a company that took one well that's producing extraordinarily well, which happens from time to time. You get the so-called monster well. And then the company can make the claim that $30 we could make money off of this well. Of course, you can't drill a monster well every time. And so what matters is the average play. But I've been astonished at the degree to which Wall Street Journal, Bloomberg, even New York Times, everybody has sort of been picking up that PR. It's just PR to me because it doesn't matter to me that one well in a company's portfolio made money at 30. What matters to me is their portfolio. And of course, that the data is really easy to come by, but I see so little analysis of it in the mainstream for sure. I don't see any of it coming out of Wall Street. I have to go to your site, and I have to go to other private sort of individuals who are just sort of, scratching through and using common sense. It feels the difference between common sense in this and what I read in the newspapers, it's a pretty big gap right now. That's how I experience it.
Well, you're right, Chris. Some of it's PR for sure, but a lot of it's just ignorance. Most of the people that write these articles, they've never worked a day of their life in the oil and gas business. So how do they know? They're smart people. Don't get me wrong. I'm not disparaging their skills or intelligence, but if they're looking at some data or they're talking to some companies and the companies say, look, we can break even at $30 a barrel, and they say, well, really? So what are your operating costs? Oh, well, our operating costs are, $4 or $5 a barrel. These guys say, okay, well, that sounds reasonable. Well, whereas somebody who's been in the business for a while says, whoa, wait a minute, really? $4 or $5 a barrel? That's ridiculous. I work for a little bitty company that has, 4 employees and no debt, and we can't operate for $4 or $5 a barrel. So what are you guys, what are you talking about? What are you excluding here? It always comes to that question. Whenever you hear a number that sounds unbelievable or too good to be true, it is. Because they're not telling you about a certain cost. So, Daniel Yergin published, an op-ed piece last week. I think it was in the Wall Street Journal or the New York Times. I don't remember which. And, he said that, a lot of these shale operators have figured out how to make a profit at lifting costs of $20 a barrel. Well, what does that mean? Well, that's not their total cost. That's their cost of operating and lifting, getting the oil to the surface. Okay, that's like saying that my housing cost is basically my gas and electricity and other operating costs less the mortgage. Well, what a sweet deal that would be if I didn't have to make my mortgage payment. That's what Jurgen's talking about. But people don't, they don't understand the subtleties of the language and the jargon to know that, no, he's really not saying that they're making money at $20. He's leaving out all their capital expenditures. Well, yeah, okay. Leave out major capital expenditure. If you don't have to account for that, gosh, I'm a rich guy if I don't have to, to pay my mortgage every month. Geez, I got a couple of $1,000 to, that I didn't have before, except that I do, and they do too.
Well, now this is a really interesting piece now. So if we look at the amount of, you mentioned this before, cheap debt financing, obviously a component of this story. And when we look at just the yield hungry people who are willing to, I think, toss prudence out the window and just chase that yield, we're seeing the ripples in the high yield market, which is really heavily concentrated in some major distress, of course, in the energy side of this. But all the numbers I've read, Art, say that somewhere between $250 and $300 billion of debt stands on these shale operators. And maybe they've got some more equity. Let's say it's $100 billion. So let me just round crazily and say that this is around, $370 billion total outstanding debt and equity that investors would love to see back. And then I wander over and see a $36 barrel for oil. Even if they were getting that full price, it means that 10 billion barrels of oil has to be sold off just to service debt and equity. This is no SG&A. This is no overhead. This is no well disposal costs, no decommissioning, no severance tax, no royalty payments, nothing, right? When I look at it that way, just sort of high level, Art, I'm looking 10 billion barrels. What are the reserves, total reserves across all the plays that these operators are in? It can't be a whole heck of a lot more than that, can it?
Proven reserves of the United States as of EIA's latest report a couple of weeks ago are 40 billion barrels of oil. Now, there is proven undeveloped, which is, another category that is also proven, which, you can add another 40 or 50%, but the number you're talking about there is a huge proportion of the total United States proven reserves, any way you cut it. And so, be scared. That's the message.
Well, I'm thinking out of that 40 billion, some of that's in the Gulf of Mexico, which, doesn't apply to the companies I'm talking about. And some of that's still locked in regular conventional fields that have been producing for a very long time. Some of that's associated with all the stripper wells that are out there doing that. But I'm thinking like the shale play operators who are squatting on most of that debt number I announced. I mean, they're really just in a few plays, aren't they, at this point?
They're really just in three plays. They're in the Bakken that we've already talked a little bit about. They're in the Eagle Ford, and to some extent, I think an exaggerated extent, they're in the Permian. And all the rest of the plays put together, don't amount to really a hill of beans, and in my view.
Yeah, so the how many billions of barrels are standing across those three plays? I've seen wild claims. I don't really know where truth lies at this point in time, because in fact, they've been reasonably good at finding stacked plays, meaning there's different layers of those shales stacked one above each other geologically, and they've gone into those, and some companies have said, well, we can put dozens of wells right near each other, and there's no well interference, and others have been less. I don't know what's actually ultimately going to come out of those plays. So where's reality? Do you think reality is closer to what the EIA thinks or what the oil companies are saying, or where do you see reality in this story?
There is no difference between what EIA is saying and the companies are saying, okay? So there's two realities here. There is the reality of truth, and like go to jail truth. Okay, that's what the companies actually report in their quarterly and annual filings to the Securities and Exchange Commission. Okay, and that's where EIA gets its data. That's where EIA's proven reserves come from. So there's that reality and that truth, and I think it's reasonably close to the truth. And then there's what companies tell investors, who will believe almost anything and don't understand, again, like Jurgen's lifting costs. They don't understand, nor should they be required to understand, that he's not actually talking about total costs. He's talking about a subset of costs. So your question, okay, the proven reserves of the Bakken, according to the latest EIA, which comes from the companies, is 6 billion barrels. The Eagle Ford is a little more than 5, and the Permian, this is tight oil, and the Permian is about 700 million. And you add up all the rest of them, the Niobrara and the whatever, the Mississippi Lime, and you name it, and the total is about 13.5 billion barrels. That's the truth. And there, yeah, and there's there's probably an almost there's a slightly smaller but large proven undeveloped reserve category as well.
Well, so Art, I was just reading an investor presentation where one company claimed to have access to almost that same number just in the Spraberry place.
Well, yeah, I mean, Pioneer Natural Resources, that, truthfully is not a bad company. I mean, if you just look at their financials, but their CEO, Scott Sheffield, has been making just absolutely preposterous claims for several years now about this Sprayberry, resource that they have out in the Permian Basin. Now, I mean, the Sprayberry was discovered in 1946, for God's sake. And in the industry, we talk about and have talked about the Sprayberry as being the largest non-commercial field in the world. And we've talked about that for 50 years because nobody can figure out how to make money off of that deal. So, so Sheffield says that they've got 10 billion barrels in the Sprayberry. Well, but listen to his words. What is he really saying? He's got himself protected. He says that they've got 10 billion net recoverable resource potential. That's not a reserve. Okay, so what is a resource? Well, a resource, and I'm going to the Society of Petroleum Engineers here, the definition is a known and yet to be discovered accumulation. It's vapor. we kind of know it's there, but we haven't found it yet. And so that's a resource, and now he's talking about a resource potential. So it's not even a resource, it's a potential resource. So what he's saying is that it's some vague number that we kind of think may be out there. And of course, a resource has nothing whatever to do with price. It's absolutely not. I mean, it doesn't have anything to do. It's any price. It just says it's technically recoverable. So it means nothing. Zero, zip, means nothing. So he's covered. He's not, and this is, I'm about to publish something here, maybe today. And, the subtitle of this section is called "It's Not a Lie If We Tell You It's a Lie." And that's the name of the game. That as long as the investor presentation or the news release says somewhere that we're using language here that we would never ever use in an SEC filing because they put us in jail, and so you guys need to know that. In other words, we're lying. Then it's technically not a lie. It's not fraud because we told you it was a lie.
Well, I guess what? If they're going to parse and play word games and do all of that, and there are companies in the business of raising capital, I got to be honest. I'll give them a little. I understand that's the game they're going to play, right? It's the old saw about what's a gold mine? Well, it's a liar standing over a hole. That's been part of the resource extraction business as long as possible. Where I part ways is with the so-called analysts who are supposed to know better, in particular, and then the Wall Street machinery that is really just pulling a Lucy with a football moment on investors again, and then a little bit less so because maybe they don't know any better, and they're not not every journalist is got the right training to write about what they're writing about. But once you leave the company's lying lips, there should be some sort of a way of getting that data accurately parsed back into human language that investors can understand. And I've really been astonished at just how wide the disconnect is between the amount of money and the value at which that money was given to the shale plays and what I assess to be their actual realistic prospects. Where do you fall in that particular dynamic?
Well, okay, so let's talk about the Permian Basin since we're on the subject. So so I looked at Pioneer's Sprayberry position, And I did my best to be objective about it, even though I admit if everybody in the industry knows that it's never been a commercial field, I mean, it's hard not to have a certain amount of prejudice going in. But, the bottom line on this thing is that the wells kind of stink. I mean, they're just not very good wells. These wells cost about $6 million a piece to drill. And the most optimistic EURs that I can come up with here are something in the order of less than 150,000 barrels of oil, and so you don't need an economic spreadsheet to figure out that you got to have at least $100. In fact, in the Sprayberry, you need something like $101.77 to break even at the specific reserve number, the most likely reserve number that I've chosen. So, that's something that would be marginally commercial at oil prices way before this crash occurred. So you'd really think twice about whether you wanted to bother with it then. So, Pioneer and all these other guys, they can draw diagrams on whiteboards till the cows come home about the stacked nature of the thing and how they can drill, multiple laterals. But the question always is great, but what does it cost? And at what point does the cost justify the return? I mean, this is not a hugely complicated business question. It's not can you do it? It's can you do it and make money at it? I mean, that's what business is about. And the answer in the case of the Sprayberry is in the best of times, you'd have to question whether it was worth doing. Now, having said that, the Bone Spring play that EOG's involved in is a better looking play. And, according to my numbers, they can break even at something like, $50 barrel oil. Now, we're at half that today, so it's not even remotely commercial at today's prices. But, at some kind of reasonable price, yeah, that's probably something you'd want to pursue. Now, the larger question is, are these new reserves, or is this just a secondary recovery project? In other words, you've just, instead of using water injection or CO2 injection, now you're using horizontal drilling and hydraulic fracturing to more efficiently recover reserves that you already know are there. And that's what I think it is, really, in the Permian Basin. That's what I think.
So, and to be clear, the Permian Basin was discovered a long time ago. It's got a lot of holes poked in it at this point in time. Are these companies really going after fresh, untouched place where they use hydraulic fracturing to open up something that was otherwise not going to be useful? Or are they in some cases, drilling within and around existing pipes and holes that are already in the ground? And I mean, where are we in this play? Are we really exploiting a brand new undiscovered resource, or are we kind of like nibbling it around the pockets that haven't really been hit well enough yet?
Yeah, it's the latter, Chris. And if you look at a map, what you see is that a lot of the activity by companies like Pioneer and EOG are at the margin. They're kind of at the margin of these accumulations where they weren't commercial before, and so they didn't claim reserves. And now by coming in and drilling horizontally, they can recover some volume that technically, I guess, might be called a new reserve. But again, it's a hugely more expensive process. And so the question is, a reserve is not a reserve if it isn't commercial. This is something that maybe people don't understand, but a reserve is a volume at a price. And it's not just any price, it's today's price when you book it. Okay. So if it's not commercial at $30 a barrel, it isn't a reserve. You can call it something different, but it's not a reserve. Okay. And so you can't call something a reserve that would be commercial, like I just told you, at $50 a barrel, because they're not getting $50 a barrel. So it ain't a reserve.
So I guess this would be like if I had somebody opened, like I have a bank account, it's in my name, but it's in England. Okay. And I'm in Massachusetts. So it's in England. and there's $100 in that, but it's going to cost me, due to taxes or whatever it costs, it's going to cost me $100 to bring it back over here. The amount of money I have in reserve really in England is zero. If I can get it back over here for $50, well, now it's worth $50 to me. But if it's going to cost me $110 to get it over here, it's not even nothing. It's less than nothing to me, right?
That's exactly right, and that's what I'm talking about. And again, I don't want to come across too negatively here, because I mean, I think it's say like $45 a barrel. I mean, there are pretty considerable areas of the Bakken that actually break even or make a little bit of money. I mean, they're not hugely profitable at $45, but they work. And the same is true for the Eagle Ford. The Eagle Ford and the Bakken, as tight oil plays go, are really pretty good. Okay, and the rest of them are either pretty bad to mediocre to really bad. I mean, that's just it. And so this notion that that somehow shale opens up this vast new world of previously unavailable or unknown reserves is only a little bit true. It's only true for the very best of a very specific kind of shale. It's not just any shale. It's a very specific kind. And if you look at the world, well, of course, there's more potential in the world than there is just in the United States. But I mean, I can name, I can list on one hand the number of comparable plays or potential plays in the world, like the Bakken and the Eagle Ford. That doesn't mean there aren't more. That's just all that we know about right now. So of all the gazillions of shale basins in the world, what I'm telling you, Chris, is that there's probably 5 or 6, fewer than 10, that we would say are in the same class as the Bakken and the Eagle Ford, which are not commercial at current oil prices. So this end of history idea that shale changes everything, it adds some reserves at a high cost that we didn't have before. Okay, I'm not, there's no problem with that. But we've got to be a little bit careful about thinking that that peak oil is now a dead or a bogus concept. It's given us a few more years is what it's given us, but it's given us a few more years at a considerably higher price, and that's what the world is reacting to right now. That's a big piece of why we're in trouble right now with oil prices, because the world kind of voted with its feet and said, you know what? We can't stand paying $100 a barrel for oil, so we're going to use less.
Well, yes, with over $200 trillion of debt outstanding, of course you have to service that debt, and high oil prices just don't help that. So, the model I've been working with for a long time is there's a price of oil at which the world economy chokes, and there's a floor at which the energy companies don't want to pursue oil anymore. And that ceiling and that floor have been coming closer and closer together. So here we are. We're clearly at a price below which oil and natural gas. In America here, I'm staring at natural gas at $1.83 is the quote I've got on my screen right now. Yikes! That's way below the all-in cost for most companies that I've been looking at. But let's dial this back a bit. So globally, we've seen this astonishing pullback in CapEx spending by the oil majors, by the mids, the miners, national oil companies, all of them, over $1 trillion by a bunch of estimates. Talk to us about what's the impact on future oil supplies with this just absolute destruction of CapEx spending globally.
Somewhere between profound and extreme.
Okay.
Yeah, I mean, we've got to be constantly discovering, several million barrels of oil per day to make up for our consumption. And it's easy to get confused and to say, well, geez, we've got such an oversupply right now, we don't have to worry about that. Well, we started this conversation with your important observation that we're only talking about 1 million or 1.5 million barrels a day of oversupply. Okay, so we could go from oversupply to deficit pretty quickly, because we're not investing in finding that additional couple of million barrels a day that we need to be discovering. So we're deferring major investments, and we're not just deferring exploration. We're deferring development of proven reserves. So just the capital cuts in U.S. companies have effectively deferred 20 billion, or maybe the world, 20 billion barrels of development of known proven reserves. Okay, and so if we get to a point, and we will, we almost certainly will, where suddenly everybody wakes up and says, "Oh my God, we don't have enough oil. We're now 500,000 barrels a day below," and what happens? Well, the price shoots up. Okay, and that's the way commodity markets work, and everybody says, "Whoopee, let's get back to drilling big time." Well, there's a big lag. There's a huge time lag between when the price responds and people actually get around to drilling, and they actually start bringing the oil onto the market, and it becomes available as supply because they've been asleep at the wheel for how many months or years. And so you don't just turn a valve and all of a sudden everything's okay again. We saw this during the Libyan civil war. Saudi Arabia said, "Don't worry, guys. We've got all this spare capacity, we'll just turn it on and produce it, and the world won't see a shortage." Well, it never happened because they had to actually drill wells. Their spare capacity means they got to drill wells to produce it, and that takes time. They got to drill it, they have to test it, they have to build pipelines, and by the time they actually got any of that work done, the Libyan conflict was over, and we've now seen low production because the civil war continues, but that's another story. So, there's this tremendous gap between, okay, we know there's a reserve, but what's it take to turn it into supply? Well, it takes time and it takes money, and it doesn't happen overnight.
Well, no, and it's, as you mentioned, it hasn't just been the exploration, but the more pedestrian stuff like infill drilling, that's pretty much come to a complete halt in the North Sea, as far as I can tell. And looks like Mexico's not doing a lot with their investment down in their plays at this point in time, and Brazil doesn't even begin to know how to get started with their whole Petrobras scandal and drilling through those really, really expensive deep water finds that they've got. Just don't make any sense at this price. So when I look across, really, where the oil growth, supply growth has come from, Art, I'm pretty much like, it's really down to the Middle East and this hope that the United States could rapidly ramp up its shale miracle, air quotes around miracle, if prices spike back up. But I'm with you. I think that as much as people are focused on the oversupply right now, in 2 or 3 years, I'll be really surprised, unless the world economy crashes and demand goes down, with that caveat attached. I think the world will be equally surprised by the shortages that are coming, because you can't just, here's what I see. I look at this chart and I talk about this in talks, and I say, hey, look, from 2005 to 2012, the world spent about $3 trillion on upstream oil and gas exploration and production, and basically got the same amount of crude and condensate out of the ground for its trouble, right? We doubled our investment on a yearly basis from 300 to 600 billion, and basically held production flat. I can only imagine what happens to production once you take $1 trillion and spend off of the top of that. Obviously, it looks like, to me, we're going to be facing a multi-million barrel a day shortfall as long as things don't fall apart on the world economy stage. So
I think even if things do fall apart on the world economy stage, you think about the, I haven't done this because the records aren't there, but you go back to a period like the Great Depression in the world, and it's not as if people stopped buying and selling goods or transporting themselves or materials. I mean, it was a big, it was a depression. It was, and there were a lot of people out of work, but the world moves along, and consumption of oil and natural gas isn't going to go to zero. And I think the I think the forecasts that we've just recently seen from the International Energy Agency just last week, they're saying, okay, so demand is probably going to be down from 1.8 million barrels a day of growth to 1.2 million barrels a day of growth, and that's awful. But wait a minute, 1.2 million barrels a day of growth you're still growing at a fairly high rate, and so you got to be replenishing your supply, or else you reach this this 0 point where you're in deep trouble. So I'm with you, Chris. Even in my darkest view of where the economy could go, I find myself on a very different page than most of the forecasters who think that we're in for a decade or decades of low oil prices. I think we're going to be struggling under the yoke of much higher oil prices, probably beginning next year. I'm not a price forecaster, but it's hard for me to see. I am a supply demand kind of guy, and I would be very surprised if by this time next year we're not seeing oil prices moving toward something like $60 a barrel. And you look at the forecast, and what EIA says, average price in 2016 will be $53 a barrel. So, they're not always right, and the fact they're often wrong, but they're not stupid either. They're doing the best they can. They got some good people there. So I think this notion that we're somehow stuck in $30 or $40 oil forever and ever is it just doesn't square with the reality.
Well, it would mean that we're anticipating that oil is going to stay below its marginal cost of production for a very long time. It's very difficult for any commodity to stay there for long, but oil in particular, because of its stock versus flows. Yes, there's a 3 billion barrels above ground right now, but hey, that's only so many days of consumption if you decided to stop producing. So yes, I'm with you. So I think that obviously oil has to go up in price at some point, and that's even exclusive of any geopolitical sort of accidents that might happen in the Middle East. Just simple supply, demand, and all of that. So if oil does go back up, isn't this last question here? You study the companies that are involved in this very carefully. And I think a lot of investors, especially the banks who've put the lines of credit out there, are really double fingers crossed, hoping that the price of oil moves back up and all of these problems that these companies are facing economically will sort of be in the rear view mirror. Would you share that view, or do you think that even if oil rebounds, there's a number of companies here that have gotten themselves in over their heads with respect to debt versus assets?
Well, just turn the clock back to 2012, 2013, when oil prices were sky high, were $100 a barrel or more, and what we saw was consistent negative cash flow from virtually all of the major players. So what that says is they weren't making money when oil prices were high. So is it a big shock that they're hemorrhaging when oil prices are lower? So oil prices go back up. The bottom line, Chris, is the only way that they were able to stay, looking fairly good back then to somebody, not me, was that people were giving them money. They had infinite access to capital at almost no cost, and so they were spending it. But their income statements and balance sheets look like crap, and the investment community, I guess, was willing to look past that, or didn't want to look at it, or whatever. So, rear view mirror, no. These are companies that are highly leveraged, and unless and until that changes, and maybe that's one of the positive outcomes of this. Maybe we see a turnover of players. There are better companies whose balance sheets look better, and they're the ones who can afford to say, okay, we're going to slow down production right now because we don't have the same debt service that the guy next door does. So my hope is that like all crises, this is going to flush out a lot of the bad players, or at least some of them. But will higher oil prices solve the problem and save the day for the people that hold the debt? No, it won't hurt. But if they couldn't make a profit at higher prices, going back to higher prices doesn't fix the problem.
So for many of these investors and players, the investors, in many cases, the best they can hope for if oil prices rise is a higher recovery of cents on the dollar, but they're probably not going to get back to whole on this.
No, it's unless somebody's willing to forgive debt. If we get that bad, then there's the solution of last recourse, right?
Absolutely. So I've been looking at your site, and I would really advise people to go there and take a look. You've got a great piece on the Haynesville shale play, where they need gas at $6.50 to break even, and even at Henry Hub it's $1.85. So and I understand why. I'm in Massachusetts. It's December 15th today. I'm in a T-shirt. It's just been extremely warm all across the east part of the country, so we're not burning the gas, I guess. But I would advise people to go take a look at that. Look at some of the other things you've got on your site. Great writing, great analysis. And so they find that at artberman.com. Art, is there any other way people can find you and follow you?
That's the best way, Chris. Artberman.com. And there's contact information there. And you talked earlier about how do you decode all of this? And I'm not the only one. I mean, you mentioned Dave Hughes. I mean, he's just a solid, reputable analyst who does really good work. And there are, hosts of other people. And so if investors really want to know the answer, they just need to look beyond the headlines and look beyond the propaganda, and certainly look beyond what the companies say, and find someone who can say, tell me what this really means. But go to my site, or and there's enough information there. Contact me, and I'll refer you to somebody if I'm not the right guy.
Well, thanks for that. And Art, I want to have you back on because I have a dozen questions we didn't get to. But I want to thank you so much for your time today, and hopefully we'll continue this conversation soon.
I look forward to it, Chris. Thanks a lot.